we're going to be talking about TSP today, and I hope that you're tuning in for learning more about your TSP. So welcome everybody. We're hosting Redfed's session, which is a Federal Employee Retirement Training Program on the TSP. And today we're going to be talking a little bit about some of the things that are affecting your TSP funds. We're going to start with some of the basics just for folks that don't know some of the basic contribution limits, withdrawals, loans, things like that. We'll cover that for about 10 minutes, and then we'll start going to some of the market trends and allocation kind of tips. Then we'll move into some of the things we want you to know about your Roth TSP, why the Roth TSP is important, and why we see that as actually a more important tool for the future. So that's going to kind of be the agenda today. Hope that kind of fits with what you're looking for to learn. My background is as a certified financial planner. I double up as a chartered federal employee benefits consultant, and I've been in the financial industry helping federal employees for all of my career, which has been 18 years. I'm local to the area, attended Towson in Baltimore, and then finished up at Georgetown there in DC. So that's a little bit about me. As we kind of go through some of the slides, you might have questions. There is a Q&A section on the Zoom functions there. You can ask questions. Most likely, I'm going to take those at the end, just simply for the folks that are on a time limit here. I want to make sure they can get out and not have the presentation extend further for them. The other thing too is you're going to ask most likely about the slide deck and recording. Yes, those will be sent out to you. And then additionally, there's one other function that comes up, which is closed caption. You have the ability to toggle that on your end, and that is in the function bars in the Zoom that you have. So without further ado, let's kind of get into the seminar. So the webinar we have today, again, is about thrift savings plan for those that are joining in. Hope you're in the right place, because that's what we're going to be talking today about. So let's really quickly start with the contribution limits for 2024 for your TSP. Those have been lifted up higher to $23,000 for folks that are under the age of 50. But if you're over the age of 50, you can contribute an additional $7,500, which give you an overall contribution limit of $30,500. So I get a lot of questions. Well, Neil, how do I know if I'm hitting that limit? I'm putting money as a percentage. Is 15% the maximum? Well, honestly, you can put in that money by percentage to the TSP, but it actually works out to a dollar figure, right? So you need to calculate that for yourself. Now, the TSP will never allow you to put in more than what the contribution amount is in terms of a limit. They'll stop you. But what you need to also know is that if you max out before the year is over, you will actually lose some of your match. I'll talk to you in a second about that. Some other additional features, right? We can jump to, if you're one of the lucky ones that get to retire before the age of 59 and a half, you have the ability to withdraw a little earlier from the TSP than normal retirement plans to avoid a 10% penalty. You also have the ability to loan up to 50,000 and actually 100,000. We'll show you how to do that from your TSP. And you have the ability to allocate between Roth and traditional. Most folks know that one. I'll talk really quickly about this Modernization Act that took place a couple years ago. It now allows folks to withdraw up to 4 times a year if they're 59 and a half and above. It also allows them to toggle between withdrawing from Roth and traditional when they are withdrawing from their TSP, which is a good feature. However, I will say one of the features that doesn't exist in the TSP, which I would say is a drawback, is it doesn't allow you to pick and choose from your funds that you're withdrawing from, which to me is a detriment in retirement. It's not so much a detriment while you're working, but it's a detriment in retirement, because think about this. If you load up a safe portion of your TSP, which is G, maybe some F, and you think, hey, I'm going to use that money without affecting the rest of my money in retirement if there's a recession or something. It doesn't really work that way with the TSP. It is a percentage-based withdrawal across all of the funds, no matter what you choose. So that to me is a little bit of a downside in retirement. Again, not so much while you're working. The other thing that you need to know about the TSP traditional is that you're required to make withdrawals at a certain age. That age, for the most part, will begin at 73. For some, it'll be 75. But just keep in mind, there's a requirement, which is around 5% on average from your TSP that you must take out beginning at that age. Now, to me, the fact that that adds on federal employees is more detrimental because you all have pensions, Social Security. The average private sector folks do not have that. So this can push folks with pensions like yourselves into higher tax brackets, higher Medicare brackets in retirement. So the advice giving to you, which trickles from private sector, doesn't really line up with your specific issues. And we're going to talk about that in this presentation a little bit as well. Now, the other thing is they changed the ability to change your withdrawals. So you can change your withdrawals at any time before you have to wait till open season in retirement, which was a total pain. Now that's been adjusted. So that's a positive. So again, just kind of doing some housekeeping items on the TSP, generic general stuff. If you didn't know, they opened up a mutual fund window, which was essentially last year, at the start of last year. It gives you the ability to choose from 5,000 funds and allocate up to 25% of your TSP in this mutual fund window. However, keep in mind, there's some additional fees. There's fees for maintenance costs and things like that, but there's also trade fees. Those trade fees are a little high. They're basically around $30 per trade. In a perfect world, we don't love the transaction fee model. We don't see that as a fiduciary model, especially in the advising world. So we don't really love these higher fees per trades in the window. But if you're looking for further allocation to your TSP, it's a good way to offset the fact that you only have these 5 fund choices outside of the L funds, which use these 5 funds again to diversify your TSP a little bit more. Okay. I'll talk about some of the diversification issues we think are in the TSP right now and why the window could make more sense. Let's get out to loans. I'm moving quickly because I want to get you more into the meat of the presentation, not so much to general stuff. But for someone tuning in that doesn't know these things, I think it's important to hear that if you ever were in a jam, by the way, this is a beautiful slide. Look at this lake. Oh, I just want to be right there right now, right? Reminds me of a lake I saw close to the Crater Lake in Oregon. I stayed at a camping site, and I remember it looks sort of like this, minus that little box out there that you could swim to, though. That looks cool. Anyway, TSP loans, right? If you find yourself in a situation where you're kind of at your wits' end, you need money to pay off something else, right? What's the better method to use your TSP if you must do that? Is it to take a withdrawal? No, because a withdrawal, most likely under the age of 59 and a half, if you have to do it, comes with a penalty. So therefore, you could take a hardship withdrawal and not be set to that penalty, but there's some other negative things that come with a hardship withdrawal. We don't recommend those. So what would we recommend if, let's say, you had super high student loans or some other issue was causing you some really financial hardship where you had to take money out of TSP? We recommend a loan. Why? Well, you have these abilities to take out the general loan or the primary residence loan, right? And really loan up to 100,000 bucks. These 2 loans are 50 each. The interest rate that you pay is the G fund, which has gone to about 4% right now, which isn't as low as it was. However, it's in the way that this loan gets repaid is where the benefits are. So imagine, right, you are paying back interest to the TSP. Is the TSP keeping your interest? The answer is no. They're not actually hanging on to your interest. Your interest is actually being credited back to your account. So in that scenario, are you is there a negative for taking the TSP loan? Yes, there is, because what would normally be in your TSP growing with the fund mix that you would have is now taken out of the TSP. But is it better than the latter, which is just getting a 10% penalty? And also, by the way, if you take a withdrawal from your TSP, you're paying taxes on that, which you don't have to pay in a loan. So you're avoiding taxes, you're avoiding the penalty. We just like this as a better method, and interest is being credited back to your account. But again, don't abuse this one. This will definitely hurt your retirement outlook because you're taking money out that won't be growing, and then of course you're paying it back. It's not going to kill your retirement outlook, but it will diminish those goals of when you're trying to retire. But it's better than the latter, which is just a straight withdrawal. Okay, so I just put this out there. There's one other change. Before, you had to have this paid back before retirement, which was also kind of a bogey that you had to avoid. Now you can actually go into retirement with a debt outstanding from this TSP loan, as long as you have a repayment plan. Okay. So again, I I have sometimes trouble talking about this one because I don't want people to do it, but I want people to do it if it's their only option. Okay. So the TSP actually helps you offset risks in retirement. That's really what the TSP for is for. It helps you offset the risk that you're going to live longer, right? Here you have kind of some statistics of couples that are now living longer. It helps you offset the risk associated with inflation. We once kind of thought, well, inflation's not a big deal. It was around 2.5%, but that's raged to a much higher number. It's been coming down, but we could be in a higher inflation regime for the next decade. We don't know yet. Okay. It helps offset things like Social Security, healthcare costs going up. Not so much you have risks in terms of healthcare costs on your FEHB, but you do have some risk towards the end of your life with in with call it long-term care type of issues, right? Those things your health insurance does not cover. So if you need nursing home, in-home care, all of that, and you don't have the insurance, you're going to have some mighty expenses at the end of your life that the TSP could be used for there. The other thing is taxes. We are in a really low tax rate environment comparatively from where we are in terms of deficit and budget. It would not surprise us that tax rates could increase in the future. And we'll give you some guidance on that when we get out to Roth. That middle category is not so much what the TSP offsets, which is market performance. But of course, you can make some bad decisions around risk. You can either be too risky when you get closer to retirement, or you can be not enough risk at your earlier parts of your career, taking conservative type of allocations and just not getting the growth you're supposed to. So we're going to address those both today. But one thing I wanted to kind of bring back up, which was about overfunding your TSP and not getting that full match, that kind of shows you right here at the bottom of this slide is essentially the TSP match is broken up into 26 pay periods. And if you hit your max by the 24th pay period, right, you wouldn't get that 25th and 26th pay period of your match from the TSP. You want to ensure you're getting that full 5% match. And that's to make sure that you have contributions going in for all 26 pay periods. Does that make sense? I hope it does. Hope it didn't confuse anybody there, but got to make sure you're getting that match and got to make sure you're not maxing out before the 26 pay period is all. All right. Moving into how to allocate your TSP. This one's a tough one. It actually comes from a blend of my financial planning book, which is used for the CFP certification. And it kind of takes in a spin on federal employees. I'll kind of talk to you about it. So essentially what this means is if your goal was to retire at 62 and your and you began contributing to a retirement account, which is below, what would be the percentage that you would have to contribute to your TSP? Now, this would also include the match, right? So if you began at 20 years old, then the 5% plus the 5% match would be ideal in terms of retiring at 62. You don't have to put in much more. But for most people, they don't seriously start contributing to their TSP till maybe 30, maybe mid 30s. Now you can see how much of your allocation or sort of contribution of your paycheck actually has to go in. So if we were to kind of say, okay, at 16%, how much is your contribution? How much is the TSP match? Well, I would say, I'll get my pointer here. Okay, would it be 11 of your money plus a 5% match? That would equal the 16, right? That's how much you would have to contribute if you actually started to get serious about contributing at 35. So all this slide is really meant to do, it's not meant to address really specific individual type of concerns about when to retire in retirement. It's just a gauge for folks that might be tuning in that are younger that need to know how much they should be contributing. As you start to get further out in your career, you need to really take in all accounts, what's your pension, what's your social, how much you saved, how much your expenses, what's your big ticket expenses in retirement, what type of support are you giving your family, and so on. But this is a more helpful for someone that's kind of getting started. Additionally, another helpful chart for someone getting started is this, very basic. Again, for someone that's getting closer to their retirement, they're going to follow something that's more so what we call a bucket strategy. They're going to do a financial analysis for themselves to figure out how much do I need in safe investments, at least for my first years of retirement, right? Let's call it 3 to 5 years of retirement. So as the market falls, I don't have to touch the investments that were invested in stocks. But let's say you've got many, many, many years before retirement. This is a good way to start thinking about your allocation, right? If you're 40, you can put the majority of your money in stocks. 50, that's a 70-30 portfolio. And as you start to get to 60, that's a 60-40 portfolio that you can be invested in. So what are these 5 funds that we talk of? Stocks, bonds. Let's go over them real quick. So G fund, what is that fund at this point? Well, it is actually put in as a cash investment to your allocation at this point. It is the equivalent of savings. All right. Um, so when you have money in the G fund, call that savings at this point. It's paying around 4%, which are what banks produce. It's very interest rate sensitive, which means if the Federal Reserve raises rates, it'll go up in interest. If the Federal Reserve decides that they're cutting interest rates, it'll go down in interest rates. So what's the expectation of the G fund moving forward? Probably less interest, right? The Federal Reserve is kind of on this decision-making process. Do we cut? Do we leave them the same? But I think nothing that I've heard about is that let's raise them more. So I think we can determine the G fund is probably at its almost highest level, and that the only risk going forward for the G fund is that they cut, right? And the interest rate reduces. F fund, what is this? This is a bond index for the US, an aggregate US bond index. Okay. I'll talk to you about how the F fund works and what we think of it moving forward here in a second. But understand it's just an index that tracks a US aggregate bond index. So we're talking treasuries, corporate bonds, municipal bonds, mortgage-backed securities, all part of that allocation within it. Most of that allocation does tilt towards treasuries. So it is on the, call it safer side when it comes to recessionary type risks. C fund, S&P 500, maybe. I mean, let's be honest, this has been the cream of the crop for the TSP. You held a strong allocation to your C fund or a big allocation or even all of your allocation to C fund, you've done well. Kudos to you. Now, the question is, can this C fund, S&P 500, continue chugging forward at the trajectory it has and lead us to the promised land? That's under consideration right now. There are some risks that we see in the C fund that are a little troubling. I'm going to talk to you about that. I'm not here to doom and gloom or scare you out of anything you've been doing, but I want to give you some constructive advice around the funds you're using, and you can make your own decisions. This S fund is essentially an index that follows around 4,000 companies. Okay. These 4,000 companies are smaller to middle tier companies that are all US based. Okay. Whereas the S&P 500 is the 500, call it uh, Fortune 500. Okay. That's that index of US companies, right? So they're all large. Think Microsoft, Apple, and so on and so forth, right? Then we've got iFund. This equals international, but let's spell this out a little more clear. What does IFA stand for? And MSCI, that's just the index name. IFA, though, gives you kind of a little bit of an understanding of that. That's Europe, Asia, Far East. That's what that index covers. So you're not going to know most of those companies, right? So that's a little bit of the difference with the iFund. It's international, right? And then what the life cycle funds do is they use a combination of all of these 5 funds and they set them towards a target retirement fund, target retirement date. So what they're going to do is they're going to be more invested in stocks, the CS&I, earlier on. But as they start to drift towards that target retirement, let's say 2030 is what you've chosen because you plan to retire around that year, what's going to end up happening is 74% of that portfolio is going to become G over that time span. So it's going to trickle into G. And by the end of 2030, you've got 74% of your account invested in G. That's how it works. There's no like methodology. There's no like, hey, let's look at the markets and see what's going on. None of that. It's just a cruise control to G. Okay. So is that the best way to be investing? Well, we can't say that it's the best, but we can say that it's better than if you chose a wrong allocation for yourself and you were invested, let's say, in GNF and you're younger, then picking a target retirement fund would be way better than that, right? So for someone that's really not interested in allocating for themselves, doesn't get it, doesn't want to do it, then the lifestyle funds are okay. They're better than making wrong decisions on your own. However, because economic kind of decisions aren't going into the composition of it, you could probably do better on your own. So we'll talk about that here just in a second. So you see this slide? This slide is kind of talking about the G fund. Well, it also has the F fund, but specifically, I want to hone in on the G fund on this one. Okay. And as you can kind of see, that's that orange line. So what is the risk of the G fund? Inflation. When you look at inflation over the last 20 years, beginning in 2024 to 2004, we can notice right around here or so, the G fund has really just broken even with inflation at best. Now, obviously, in 2023 and 24, it dipped way below that line, and you had actually negative returns compared to inflation. But are you really making anything on the G fund? You may feel like you are. Over the last 10 years, it paid around 2.25% interest rate. Now, just for this year, it's spiked up to 4. Started that upwards ascent last year. But are you really getting ahead with the G fund? The answer is no. So over time, your purchasing power is remaining equal but there's really no growth coming onto that. And you could argue that you're actually probably more prone to reducing your purchasing power over the long haul in the G fund when inflation spikes. Now, someone could say, well, what's the better alternative? Are you telling me the F fund is the better alternative for my safer money? Because clearly, Neil, on this chart, I see a massive negative number. And I want to say that, listen, the reason you see this white line down so much is, keep in mind the F fund at its worst uh, return ever since the infancy of the index. Okay. Plus inflation was horrible. So, okay, plus a negative 9% on inflation. So, of course, you're seeing that 25% down. Now, the question is, though, is that what's going to happen in the future? So, let's look at what happened to the F fund. And we're trying to hopefully talk as best as possible, but I am struggling with a really stuffy congestion. So I can't breathe through my nose right now. So sucking in air and trying to talk to you guys at the same time is a little tough, but trying to get through it. So interest rates going up, send bond prices going down. What does that mean? How did that impact the F fund? Well, think about it, right? So imagine if you bought a bond. Okay, we're not talking about the G fund anymore. We're talking about the F fund. We're talking about why the F fund did so bad. Imagine if you bought a bond for 10 years, right? And you bought it 3 years ago. Let's say bonds were giving you a 3% interest rate for a 10-year bond. But now all of a sudden, the Federal Reserve has raised interest rates to 5%, and they're issuing new bonds for 5% for 10 years. What has happened to the value of your bond that's paying 3% for 10 years? Am I, as a secondary investor, wanting to give you full value for your 3% bond for 10 years when I could just get new ones for 5%? No way. I'm saying that bond's trash. So what happens is it gets discounted. And that's why you actually see bond prices move down when interest rates move up. Now, the question, that's why the F fund had its worst year. Now, the question is that what's going to happen in the future? You know, so many times you look at past performance for what's going to happen in the future, but that's not necessarily the best method, right? So now that interest rates are up to basically 20-year highs, and the forecast is for the Federal Reserve to hold those rates and not move them up any higher, and actually potentially they're talking about moving them lower. It's just a matter of when. What does that do to the F fund? Well, now the risk of interest rates moving up is really not, I'm not going to say it doesn't exist, but it's definitely not as high. So the losses on the F fund shouldn't be there. F fund is now paying a really good interest rate, call it 4.5-ish% to 5%, which is better, slightly better than the G fund. But now you actually have the reverse side of those losses potentially to happen. If the Fed cuts interest rates, then you actually have an appreciation through the prices of bonds, which would send the F fund up higher on top of the interest that it's earning. So that's where we get into this scenario. What has the F fund done in the last 40 years after the Fed has paused? Because typically after it pauses, it's followed by a cut. We don't know when the cut happens, but then what typically happens is you get your interest, and then on top of that, you get an appreciation because of that dynamic that I just talked about. Now, this is really beyond a 101 teaching to you all. In fact, there are many financial advisors that don't even understand this principle, but I want to tell it to you so you understand that we think the F fund's going to do better and outperform the G because of this dynamic, right? We don't know what the future holds and when that will happen, right? When the Fed cuts rates, and could they increase rates because inflation takes an unexpected reversal upward, sure. So there's still risk there, but it just sets up for strong performance from your F fund over the next 3 years. On average, the F fund's done 10% in this scenario. Now, again, that skews a little bit because 1984 is there, right? That's when interest rates are super high. So maybe we should be looking at, more of a scenario from '06 when they paused interest rates and what the F fund did for 3 years out. It was more of a 7%. Again, I don't have a crystal ball. I'm just giving you history so you can see it and understand how these things change your performance. So this is a chart that shows you past performance. Okay. So we're going to start at the most conservative funds. We can see return is on the left and risk is on the bottom. So essentially what this chart measures is it measures the amount of return that you made over the last decade using these funds and the amount of risk that was inherent in the funds themselves. Notice that the G funds risk is like next to nothing. Why is there like a teeny bit of risk? Because of the inflation component to it. But outside of that, it doesn't have a risk of loss. Okay. The F fund was slightly riskier than that, but it returned less. So if you use the F fund instead of the G, you actually use the worst choice out of the two. However, based on what we think will happen next, we think the F fund actually, I shouldn't draw that line because the F fund will remain the same risk, but we think it will be somewhere around here. The G fund should be somewhere around here. Gosh, these drawings are horrible. But if you get me here, we think that will flip flop. That's all. But it's important to see where things have been and where things may go. Okay, based on history. Now let's look at the stock choices. Stock choices are here. These are your three choices. So there's no question C Fund has been the absolute darling. Not only has it absolutely crushed it in terms of returns, it's about 12%, close to 12% over the last decade, but it's done that with a lower risk level than any of the three choices for your stock funds. That's pretty darn good. When we measure risk, by the way, we measure volatility typically. Okay, so volatility is a measure of standard deviation of the difference in returns. Okay, that's what you're seeing there. So no doubt, C fund, best choice of the stock funds, followed by the S fund. But keep in mind, the S fund is the most volatile or has been the most volatile. Why? Because it's small, mid companies, right? They're just not as insulated usually from the volatility. The I fund, by far the worst. It's making a little bit of a recovery, though, and a resurrection, but it's been by far the worst. Okay. So, what are the risks if you continue to use the C fund as your basically breadwinner to your TSP? Well, the main risk that we see right now is what we call valuation risks. The C fund, if you look at it, is comprised of these 500 companies, but it's these 7 companies that have absolutely taken off the tech companies, Apple, Microsoft, NVIDIA, Google, Amazon, Facebook. Am I missing one? I always miss one. I think it's Netflix. I might have missed, but you've got 7 companies that have increased their valuations considerably. Now, when you look at P ratios, what does P ratio measure? It measures price to profit, price to earnings. If you go up in price alone, that's not necessarily a good thing. Okay. Now, earnings have gone up in these 7 companies, don't get me wrong, but the valuations of these 7 companies is approaching really high levels. Okay. The average P ratio in the stock market going back over the last 30 years is right around 16.7, call it 17. Okay. So that means you're paying 17 times earnings to own these companies normally. Right now, the market is trading at 21 times earnings because of these 7 companies that have gone up in valuation. And they now comprise over 33% of the index. So a third of the S&P 500 is in 7 companies. So what does that mean? If those 7 companies struggle at all, if the expectations aren't met for the growth expectations of those 7 companies, then you can see a reversal of the S&P 500 because of the weightings in that. So just be careful. If you're overloading your C fund, you're getting really close to being undiversified. It's almost as if you're putting a large portion in just a small basket of companies. And if we get any economic environment that's slower, and those companies cannot live up to those lofty expectations, maybe they do 10 years down the road, but there's an event that causes them not to be able to live up those expectations, at least in these next couple of years, then you could see a downward revision of the price that is being paid to own these 7 companies. Little deep in terms of going beyond 101, but I wanted to give you that understanding. So the question is, well, what should I be invested in? So let's look at the L funds to help us determine this. Well, okay, let's look at the L2030. What does it invest in? It invests about 34% in G, 6% in F. That's actually a really good allocation for the bond portfolio, or let's call it the safe side, which is this, call these two, the safer side, right? Bonds and cash. That was a great allocation for the last 10 years. But based on where we are in rates and the expectations, we don't feel like the F should be so little, right? That's a lot in G. So maybe some of the G, if you're picking your own allocation, should come over into that F sleeve right now, right? Now, again, I don't have a crystal ball on when this all comes to fruition, when the Fed cuts rates and the F fund does well, or better than the G. But even right now, the F fund pays a little bit more interest in the G. So if the Fed is just flat and pauses, the F should outperform on that logic. So we just feel that that's a little low on the F. And this is not going to be adjusted based on expectations, just so you know, from the L funds. What do we feel in terms of the C? Yes, we feel like that's a pretty good allocation to the C. Is it overloaded? No. But you'll see a lot of people have a ton in their C. With the fact that that's 33%, 7 companies, I'm just a little worried about that. That's all. I don't know what happens, but I'm just a little worried that that is a heavy exposure to just a short amount of companies. Listen, if you're early in your career, mid-career, maybe you don't need to worry about that. But you're getting out towards retirement, it's a little worrisome. So what can you do? Well, you can leave this the same allocation here. I don't think that's too much in your L funds, but some people have even more than that. What I think might be a little too much though is I. I don't want to ditch I right now because of how bad it's been. And it can have some recovery because its valuations are super low. It's like 13 times earnings versus 21 times earnings. And then the S fund's like right around 16 times earnings. So it's not actually overvalued. So what I think here is that you'd want a little bit more S than what's currently in the L funds. I think 21% or 25% I is high. Like imagine if you had a $500,000 TSP. Imagine if you had a $500,000 IRA. Are you literally going out and buying, and you were like picking stocks? Are you literally going out and buying $125,000 of international companies? Probably not. So I just think that's a little high and probably deserves more of an even split between S as opposed to that much in I. I like the C where it's at in these allocations. But if you yourself have even more exposure to the C, you might want to consider reducing that just by a tad, just because of where things have got. Now, there might be a time that we reallocate more towards the C, but we're just a little worried about that over tilt towards those seven companies right now. The other thing that we'll say is things are pointing towards some slowing down in the economy. That hasn't come to fruition yet. But one of the things that we follow is the leading economic indicators, which is done by a group of economists called the Conference Board. And just notice they use this blue line. Their blue line is below the zero line. That's been indicative of recessions in the past, but the economy sure as heck doesn't think that. So I don't want that to scare you, but that's kind of where they are. They look at interest rates, housing starts, manufacturing, jobless claims, lots of different things that go into their numbers, but they are showing, hey, we should be slowing down, but the GDP is not saying we are slowing down. So take that with a grain of salt, but that's where that's kind of showing. And lastly, we'll say is generally speaking, recessions super spook investors into making bad decisions. The average investor expects to lose 22% during a recession, quote unquote, but really that's not reality. If we look at recessions going back to the 1950s, right? Recessions are a mixed bag in terms of how bad performance is. And that's because not all the time does the market actually drop during a recession. Sometimes it can drop 6 months before a recession. Sometimes it can drop 12 months after a recession. So if you're thinking that you're going to time trying to get in and out of the market, it's not going to normally lead to better performance for you. What you want to look at is 3 years out, 5 years out. What do the numbers look like then? Well, pretty much all but one time going back to the 1950s, the market is higher 3 years out. So can you stand the pain during the recession for 3 years? Hopefully you can if you're, at least 3 years away from retirement, right? But bottom line is, yes, recessions can be brutal, but it doesn't mean that the performance is down during the actual recession period. Markets can drop before it, markets can drop after the recession is done. And that's why they're really hard to time. So we show this as a chart to dissuade you all from actually trying to time markets. That's all we're doing here. We're not trying to say that you shouldn't be allocating properly amongst your stock choices and using valuations and risk valuations in terms of that. What we're trying to say is it's really impossible to time, right? You see in this chart, it's really impossible to time. So you got to think that 3 years out as opposed to timing it. So that's where we kind of come in with this piece. Staying invested is usually going to be your best bet. Staying diversified is also a best bet. And that's where we're a little worried about that concentration risk amongst that C fund. But ultimately, this is kind of the decision making around the TSP that we're making on our end, and the thought process around picking our own investments with our portfolios is being kind of taught to you in your 5 funds here. So I hope that made sense. I hope it didn't complicate too much. We threw a lot in there. In fact, I probably went overtime because now I only have 15 minutes for the Roth section. I know there's been some questions, but there's impossible for me to finish out your Roth stuff if I take those questions. So I'm just going to move in. All right. So really quickly, guys, right? You have the ability to choose Roth TSP inside of your TSP package there. Keep in mind, right, that the Roth TSP doesn't follow the same contribution limits outside for Roth IRAs. So a lot of people get confused. Oh, my Roth IRA, I'm only allowed to put $7,000 in, right, Neil? So therefore, I can't put more than 7,000 in my TSP Roth. No, you can put every single dollar to your TSP Roth. There is no income limitations that affect Roth IRAs on the outside, or the contribution limits that affect Roth IRAs on the outside do not come into play on the Roth TSP. Okay. So essentially, you can do every dollar to the TSP Roth if you want. Another common myth is, well, Neil, I heard that if I don't put money in my traditional, I don't get a match. No. The myth comes because the amount of dollars that you put into your Roth TSP, even if you did full maximum contribution there, is not going to give you, sorry, the agency is not going to give you your match in the Roth. So even if you put 23,000 into your Roth, they're going to give that 5% match and put it in your traditional account of your TSP. Why? Because they're not giving you tax-free dollars. They're giving you dollars that are going to be taxed later, which makes sense. It's compensation. So that is some aspects around that. This is going to give you the tax treatment of these accounts, right? If you're loading up in your traditional, what you're saying is, I want the deductions now. I don't care about the future. Tax me later on the contribution plus the growth. That's what you're seeing in that example in red. The Roth is the exact opposite. Hey, I don't need that tax deduction now. Please keep that tax deduction and just give me tax-free growth and give me access to my entire retirement account tax-free in retirement. That's what you're seeing in blue. Complete mirror opposites. All right. So you're probably wondering, when do I choose? What do I choose? Okay, I'm going to get to that. Let me explain right here, though. These are the Roth IRA contribution limits, just so you can see the difference, right? In green here is Roth IRA contributions, not Roth TSP, right? The 7K doesn't apply. Roth IRAs also have income limitations. That doesn't happen in the TSP. So just wanted to clear that up. However, you will hear of one other way to get money to Roth, which is a Roth conversion. Roth conversions are not contributions. Therefore, they're not subject to income limitations like the Roth IRA has, and they're not subject to limitations on amounts that can go to the Roth. But what is a Roth conversion? A Roth conversion is simply saying, hey, I put money in my traditional balance of my retirement plan, and I really want to just pay the taxes off on that now and move it to Roth. You can do that, but you will pay taxes when you do that on any movement. And you can do that from the TSP starting at age 59 and a half, or if you separate from service sooner. So I just wanted to clear that up with you guys. All right. So why would I move money from my traditional to my Roth later? Why would I do that? Well, because one other aspect here is the required distributions. So I think I started talking about this earlier in the presentation. If you put anything in your traditional TSP, the IRS is going to require that you take around 5% out of that TSP every single year in retirement. That number is a tad bit lower when you start, but it moves up higher. Okay. So I'm giving you kind of an average on that first 10 years of what you're going to be taking out of your TSP. Okay. Now, that 5%, if you have a small amount in TSP, may not be much when you retire. But if you got a big TSP all loaded up into traditional, you could run into some tax issues. So why would I, as an individual, want to move money out to my Roth via conversion? Well, because RMDs are not required by Roth plans, right? There's no requirement to withdraw from a Roth. That's a beautiful thing about a Roth, right? I can literally leave that money in there in my 70s and 80s. And if I never use that money, I just grew it tax free and I can leave it to kids. Think about an efficient tax estate plan on that one. So I think there's a lot of information that's left off in this traditional or Roth decision. And I think the fact that you all aren't kind of told what the ramifications could also be of having a large RMD in retirement is missing. So think of this chart, right? This is a retirement income analysis. And essentially what this is it's a case. It's a case for someone that was retiring at 62 and from the federal government. And at 62, they started their pension, right? They retired. But they decided, I am not going to take my Social Security until my full age, which is 67, right? So that's where that pink, or call it purple, comes in, right? So in the first 5 years of their retirement, which is right here, they are making some substantial withdrawals. Let's call that from the orange, which is TSP. Okay. But then notice at 67, those withdrawals reduce. There's not as much coming from their TSP. So that reduces the burden on that TSP at that point. And the thought process would be, well, great, that's just how it's going to be for the rest of my life now. I don't really need much from my TSP. And that's just, that's just all gravy at this point. Well, what they weren't considering was the requirement of withdrawal at 73 years old. So then all of a sudden, it's not what they need, it's what they must do. And now you see that massive amount over top of what they actually needed in the previous year, right? So let's just say, for the sake of this example, their need from their TSP would have increased every single year because of inflation and the fact that their first pension only actually. So one aspect to know, guys, is every year you'll need more from your TSP. Why? Because your first pension is designed to actually increase cost of living adjustment in retirement by the inflation rate -1. So the inflation rate is 3%, you're only getting a 2% cost of living adjustment to your pension. So for that reason alone, you'll need more money out of your TSP every year. But will you all of a sudden need this massive explosion at 73 over top of that number? No. So then you got to think about, well, what does that do to my tax bracket? So if like someone was hunkering in the 22% right now, or maybe it was drifting to 24%, right? And then was assuming, oh, by the time I retire, my income's going to drop, so therefore my tax rate's going to drop. Yeah, that they might have been right on that, but what they didn't think about was beyond that, right? Beyond that is the requirement of withdrawal, which is taxable if it's in traditional, because those have never dollars been taxed before, and it's required and it can't be controlled at that point in time. Can you take more than that number? Yeah, but that's the minimum number you can take. So therefore, that creates a tax issue. And this example, it sent that person to 28%. So what you don't want is this scenario happening for yourself. You were dodging 22, 24% tax rates because you thought things were going to be less in retirement, but then you got taxed at a higher rate than what you were dodging as far as paying taxes now. That would be kind of counterintuitive, right? So the next question comes up, and we're almost at the finish here, is all right, where should I be paying taxes on? Where's the sweet spot? Tell me, Neil, where's the sweet spot? All right. So what we say to individuals is look at the old tax rates prior to 2018 changes. Look at the rates, okay, versus the rates now. Where do we see a difference? Well, we see a difference in 22 versus 25, 24 versus 28. We don't see a massive difference between 32 versus 33. So we're going to say our sweet spot is, and I'm going to try to erase all ink on the slide. This is our sweet spot. Why do we also say that that is our sweet spot? Look at the income ranges, especially in this 24% bracket versus the income range then. Now, don't just look at the amount of dollars in terms of upwards amount. Look at the actual amount it encompassed. This was only about a $70,000 amount between 165 and 233. This is $180,000 of income it encompasses. So this is what we call the sweet spot. If you're thinking about conversions and you're within that sweet spot, we like that idea. If you are drifting into this bracket, which is 32%, we don't love that idea. We think you should avoid taxes there. So traditional makes sense when you start slipping into the fifth bracket, right? But if you're in the first four, do Roth. That's what we recommend. Recommend is the Roth. Why? Because we see these rates in green most likely coming back. And right now they're set to expire unless they're extended. And you will see that if you look back in history beyond that, rates were even higher than the ones here in green. In fact, in the 90s, we had rates beginning at 15, going to 25, then 28, then 31 for these ranges of income. So we're in a historical low tax regime, and we think you should take advantage of that. Okay. So I hope that that addresses that question. Oh, should I be using Roth? Should I not? You need to look at your income and look at what you have on your tax return to determine if you're in those first four brackets. That's how it works. What happens that's confusing to you? What happens if you're not comfortable doing that on your own? Well, here is where you have the ability for us to help. We offer a free consultation, one-time free consultation. If you haven't done one, that gives you the ability to have all these things talked about and examined, plus more things there on that list, right? Should you be using Roth? Are your allocations making sense? When should you retire versus when you can retire? Do you have a strategy to minimize tax burdens, right? All of those things are things that were kind of covered today. And if that's of interest to you, you have the ability to sign up for that consultation. So you can do one of two things. If you got a phone on you, you could scan the QR code, and that's going to take us to the registration page to sign up. If you're on your laptop, you can go to retfed.com/register and register that way. Now, keep in mind, we keep appointment slots available for your financial checkup. But outside of this window, there is a delay in signing up. So we're going to keep that available for about a 3 to 4 week window. If you decide to sign up later, you can. You're just going to have to wait a little while, right? Because other groups are going to have priority. So this, the only other thing I'll add to this is financial advisors. You must look at a financial advisor's background. There are a lot of financial advisors that are essentially insurance folks that are disguised as financial advisors, but their ultimate goal is to sell you an insurance policy at either life insurance or annuity. Beware. Okay. That is not going to be a fiduciary financial advisor. So how can you find out whether your advisor operates as a fiduciary, especially in the investment realm? Well, go to brokercheck.finra.org. One thing you can look at is if they're registered under FINRA, that's going to be more from a compliance aspect. But if you're looking for an investment advisor that is fiduciary, it's got to be an RIA, registered investment advisor. That's going to be someone that doesn't operate on a commissionable realm. And therefore, they're going to be able to give you advice that is not going to be transactional business. No fiduciary advisors can operate or say they can operate when it's on a transactionable level and they're making commissions on advising you to do certain things. Look for an RIA, registered investment advisor. Lastly, second to last, check for certifications. You know, CFPs are great ones because they have high ethical standards. They have a fiduciary conduct that's supposed to be adhered to. And then lastly, they have continuing education that they must do, which is almost 30 hours a year. I will tell you that if you meet with someone that has no clue about federal employees and how their systems are, how their TSP works in retirement, how their pensions and inflation components for COLA and taxes, if you meet with someone that doesn't have that background, I just don't know how you're going to get a great financial plan from that individual. I'm not going to beat up on someone that doesn't have it, but you would probably be better served with someone that does have the understanding. Okay. So again, that's it. If you missed the sign up on the last slide, you have it here again. This is our sign up and QR code and website. One other thing that we are promoting is our YouTube channel. So if you found the presentation useful, you want to learn more things that are in depth and maybe necessarily not wait until we host this again for your workshop here at USAID, you have the ability to follow us on YouTube. Now, on YouTube, we are actually posting videos on a monthly basis at least, which is on the market and how to allocate TSP. So if you want to update to what you heard, if we're updating things a couple of months out, you can follow us there. If you want tax advice, estate planning, benefits, Social Security, Medicare, all of that is going to be on our YouTube channel. Follow us there. You can flash that on YouTube on your phone and just hit the subscribe button. Okay. So that would be a great way to stay informed, if you will, if you're just not ready for the registration of the one-on-one. So that concludes, where are we on time? Oh, 2 minutes over. Okay. Almost did it in time. So you guys asked some great questions. I want to make sure they're addressed. Let's do them. Is there a good TSP calculator for contributions and agency match? I don't know. I wish I knew. There are some good websites out there, but I don't believe they come with that calculator. Yeah, I'm not going to attempt to answer that one because it'd just be a guess. What has been the F fund percentage gain over time? Good question. Over the last 10 years, not so great. Going back in history, a lot better, but that skews because you have the 80s, which is high interest rates. So I don't have the long term on that one, but I'm going to guess long term is between 4 and 5 because it takes into account some bigger interest rates that you saw back in the 80s and 90s. But again, we like the F fund actually right now. We like the F fund as a alternative to just doing so much G. I'll say that. Most federal employees, when they start getting to the later in the career, they load up on G. Fine, that's safe. But now the F fund can be used after the pain that it's just experienced. And someone may say, well, shoot, I don't even want to risk that. And I can understand because it went through some painful periods in the last 2 years. But we just think it's on the other side of that is all. All right. Next question. This could be too personal. Let me see, though. What advice do you have for someone who's not taken enough risk in the first 15 years of their career and still has 15 to 20 years until retirement? What is the best change I can make now? L fund, more aggressive. It's not that it's too personal. It's just that I can't really answer that without looking at like what your balance is in your TSP, what your expenses are and all those things. Like I'm not just going to willy-nilly tell you to get more aggressive right now, have you pop money into your aggressive balance and have you lose some of that. But what I can at least say for right now is tune up all of the future contribution that you're making into the TSP future into aggressive funds. If you are low risk on the current balance, maybe leave that as is for right now because the markets are at all-time highs. But you want to be buying in with all new stuff. And you might say, well, Neil, the market's going to drop or make a good market could drop. Sure, let it drop. Buy in at lower pricing. Just keep buying. Okay. Tune it out. So that's what you can do right now. Someone said, sorry, could you go over again? Is the total contribution limit 23K for this year? Or is it 23K in each regular and Roth? It's 23K in total. So that's a great question. So you have the traditional and the Roth buckets. Can you make 23K to each? No, it's 23K combined across both. You can do all 23K to Roth, but then you can do 0 to traditional. Does that make sense? All right. Can you fully contribute and max out to an outside Roth IRA and also contribute more to a Roth TSP account as well? Yes. Great question. So does Does the TSP contributions to Roth have any effect on Roth IRA outside contributions? Not in any single way. Nothing. So if you're in the income limitation for the Roth IRA on the outside, you can do 23,000 or you could do 30,500 or if you were 50 or over to Roth TSP. And then if you were under the income limitation for the Roth IRA, make a 7,000 plus $1,000 contribution over there to the Roth IRA as well. Mark, super helpful. Will I be able to get a recording? Yes, we'll send out recordings, but better yet, it's going to be on our YouTube station. So get on YouTube, you'll see a recording there. But that's the way we're doing things moving forward. Because honestly, guys, we've been doing these presentations for 9 years. And we've stupidly not thought of why are we putting this on YouTube? We only have 100 subscribers. We've been doing this for thousands of you guys for years, and our subscribers are so little. So help us get our subscribers up because we've got great info on that channel, but just nobody knows about it because of how we've done this over the last years. It's just been through agency presentations. So of course there's no algorithm there. But that's where you'll find all of this stuff on the YouTube. Can you contribute to both Roth and also do 8K contribution to outside IRA as well? Michelle, I think I addressed that. Yep, you can. As long as you're in the income limitation to do that Roth IRA on the outside, yes, you can. All right, that's all questions. We are done at this point. Do you guys have any more or are we good? One more. Are we allowed to change allocation for funds 2030 or 2040? I wasn't sure why I was being analyzed because we favor change IYT. Okay. I'm not sure about that last sentence, but are we allowed to change allocations? You can't change the 2030 and the 2040 allocation. No, you can't. That's set. But what you can do is make your own. So I think on the slide when I was playing around with it, saying, okay, I would bring more G into F right now, and I would bring more I into like S, when we did that exercise, that's, you would have to make that. You can't tell the L funds what to do. Hope that was what you're asking. All right. Someone said if you put more than the required amount in your TSP, where does the over amount go? They stop it. To my knowledge, they stop it. And that's how you would lose the match if they stopped your contribution because the match is scattered over 26 pay periods. Someone said, should I first try to max out my TSP before contributing to a Roth IRA? Good question. Look, it's personal preference on that one. I can't comment on it because, look, if you want the ability to invest outside of 5 funds or your L funds in a Roth IRA, then you've got to consider that you would invest in the Roth IRA before you maxed out. So it's all in personal preference and what you think you're getting in an outside Roth IRA versus what you're getting in the Roth TSP. Now, of course, you want to contribute to your match, right? 5%. But if you're looking for further allocation in the Roth IRA, then you could consider putting some money there too, right? Before you max out. It's all in what you're looking for. Does it go towards the TSP catch-up? Oh, so someone basically said, if I put in over the amount to my TSP, but you're 50 or over, then yes, the overage would automatically go to the catch-up. That's how it works. You don't have to like elect to go in the catch-up. Like if your max is 23 and you're 52 years old, and you're putting 25 into your TSP, yes, they're going to automatically allocate that to the catch-up. But if you're not over 50 years old, 50 or over, then they're going to cut you off, and then you're not going to get the match for that final pay period. Amy, you're welcome. Azara, no problem. Um, Kwame, can you share the slides? Yes. So what we do is we send out the slide deck for you guys after this. Um, Diversification is considered across all accounts, right? Allocation and TSP, and IRA Roth. Yes. Yes, correct. All right. Why not just contribute to Roth now versus doing conversion? If you're within that 24%, you seriously got to consider doing just Roth now. Yeah. But there's a lot of people on this call that may not have done that. They might have loaded traditional money and therefore they have to do or want to do a conversion later. But you, on the other hand, if you're younger and you're hearing out the issues that may come about later with that required distribution, popping you in higher tax brackets and affecting Medicare premiums. All right. This whole nose and breathing thing is tough. All right. If you are young, then yeah, load up your Roths. But if you got yourself to a later in career, then you've got to think Roth conversion possibly. That's the whole thing of why we said that. Alrighty. I think that's it. And that's sort of all I can do. You guys were great. Awesome questions. Like us on YouTube, or subscribe us on YouTube, follow us there. And if you want some more intensive stuff, come in for that one-on-one. We'll be sure to set you up properly and make sure you're doing the right things. So thank you for the feedback, and you all take care, and best of luck to you guys in your TSPs. Until next time, see you guys.